All right, so this is going to be the second installment of Trading Concepts video that, or a teaching thing that I'm wanting to do to try to help people understand the market, how things work. The first video, it talked about candles, how the market moves, highs and lows, how to identify those, how to identify trends, things like that. These videos are meant to be quick and simple. They're not very deeply technical. It's just to give you really just the quick and dirty. Okay, for those of you that don't know me, I've been trading for roughly 8 years now. I've been profitable at it over the last four. Um, I'm very new to YouTube. Don't do this at all, hardly. But anyway, um, so we covered all of those in the first video of how the market moves, candles, what candlesticks are, what the topping tails, bottoming tails are, what they represent, things like that. So today we're going to focus on more technical analysis with break of structure, liquidity, order blocks, things like that. So in the first video, I talked about looking to the left whenever we are day trading, okay, or even swing trading, even on like this daily chart right here. Whenever we are here to analyze which stocks we want to look at. Right now we're on the NQ, so these are the QQQs, but this is the NQ futures right here. And whenever we are looking at to take a trade, we always want to analyze to the left to see what the stock has been doing. Okay, it's a basic concept there, and this allows us to identify a bias as to um, what the stock, what we think, what the best educated guess is that we want to do. So with liquidity, sorry, you normally look into higher time frames to find where liquidity lies. Liquidity normally lies. What liquidity is resting orders on the chart. Potentiality for orders to be filled where they should be filled at. Normally, they're filled at pivot points. Normally, orders are resting at pivot points here and here. So, with this lower downward trend that we saw, what happened? Price action finally came down on this 4 hour chart. It swept that liquidity line right there, okay, and then moved higher. That means that there were selling orders that were sitting right here, and eventually, a couple hours later, into the next day and a half, price action came back down and filled what orders were sitting right there. That is where liquidity is. Those are the liquidity lines. Okay. There's liquidity there, resting orders, resting buy orders that would be sitting right there, or sell orders. They can be either or. Orders resting right there as well. So we zoom in, and even though we have this big consolidation range right here, and we'll get into consolidation later in later videos, resting orders sat right here, and we see price action moving into that until finally it decided to. All that liquidity was swept over the last couple of days on this chart, and then it fell through the floor. It went down. Okay, so that's a rough recap of what liquidity is. The main points that I wanted to get into are fair value gaps. So, fair value gaps is a main confluence that traders use on a daily basis, and it's one of the main trading strategies that I use whenever I'm formulating trying to make an educated guess. Okay, so basically, what a fair value gap is, it's an imbalance in price action. It's an imbalance of liquidity where market orders and price range um, that lacks the orders in the opposite direction of the market sentiment. So in this case right here, you have the market sentiment. We are in a downward trend on this 15-minute chart right there. We can zoom in on a 5 minute. Okay, we started, whenever the market opened right here, we started a downward trend. We were going downward. So what a fair value gap is it's an imbalance of the market orders and the price range that lacks orders in the opposite direction of the sentiment of the market. So what that basically means is whenever the market opened on this day right here, we had consolidation. The market had not yet decided what it wanted to do. Now all of a sudden it starts to move downward, and it moves in such a large and fast fashion downward that it creates what we call gaps. So we have a gap here, there is a gap right here, all these gaps. So the price action was moving so rapidly and so quickly that it created a lack of orders. Therefore, it created a lack of imbalance. Okay, is basically what that means. So how do you identify what the fair value gap is? Well, we take, specifically on this chart right here, what we're going to do is we take the bottoming tail of this candle and we match it up with the topping tail of the third candle. So fair value gaps, they are it's a 3 candle pattern. So in this example here, that's candle 1, this is candle 2, this will be candle 3. Okay, easy and simple. So what we do is we take the bottoming tail of the first candle, match it up with the topping tail of the third candle of the move, and we draw that out. That is what creates the imbalance of orders. Now these are going to be used as confirmation or confluences of market sentiment, market move. This gives us a good educational bias or direction. Because whenever the market does this, whenever price action does this, it has a tendency most of the time, I would say 95% of the time, price action will come back up and revisit these areas. So taking this example right here, this fair value gap here on this 5-minute chart, we see price action fell completely down in a rapid direction. We have all of these red candles. Then we find support. We find a support area down here. I'm just going to draw that as an area of support. Okay, the market comes down, creates a 3-bar reversal pattern. Okay, 3-bar reversal, that being the first bar, the second bar, third bar, right there. And then it reverses to the upside. So what does it do? It comes up, comes down, and then comes back into the fair value gap, and it starts to retest this area where all of these orders have been resting and sitting. If you think about a straight, line of liquidity right there, that is what that is. Okay, so in this example here, we see that price moved up, retested the fair value gap, and then it confirmed the bearish fair value gap. It's bearish because it's moving downward. That's what makes it bearish. Price action is moving lower, it's bearish. Okay, so now we see it comes back up into this range, retests this, and then we start to see orders being filled back out of it. So if you're a trader and you're looking at this, we see confirmation of this bearish fair value gap that is being respected, and then I would be looking to place orders outside of this. So more than likely on this 5-minute chart, my entry would have been somewhere right there, testing the low of that last candle. And as you can see, if I went short, price action goes lower. Okay, so it goes lower, then it comes back up, it retests the fair value gap again, and then what does it do? It goes lower once again. So in this instance, if you missed that trade, you had another opportunity to be able to get in short somewhere. You could either do it right there or you could have done it right here. Either way, but order entry is not what we're talking about today. But so that's a fair value gap. 90% of the time, the price action is going to retest that area. Does it have to? No, it doesn't. However, we as traders use that as a confluence of predictability. And then finally, what happened over here? Well, price action came up through the fair value gap and validated it. Okay, so once we start to see buying pressure that comes out of the fair value gap, so this candle right here, then that's a sign, that's a change of direction. Okay, that would be a break of structure, and that would be confirmation that we are going up. Now in this example here, what happened? Well, it came right back down again, but then eventually went back up. Okay, so and these happen on all time frames. It doesn't matter if it's a 3 minute, 1 minute, 5 minute, a daily chart, whatever. These the fair value gaps, they happen. And so that's why, they're beneficial to us. Okay, if price revisits that range and we see buy or sell orders that come out of the range with the market sentiment, then we can assume that more orders are going to be filled within that price range. And that gives us an idea of what the market is going to do. And therefore, there again, in this example here, in this fair value gap, market sentiment was we were going lower. We had this big move. We were going lower. It created that fair value gap. It came up, retested the fair value gap. Sell orders were filled in this area. The market moved lower. Then it came back up and retested it once more. Sell orders were again filled in this area, pushing price action down. And it happened a third time. You get the gist, okay? So that's fair value gaps. Now, if the gap is inverted, in this instance right here, okay, then we can assume that market sentiment has changed, and then that's a confluence that price action is going to move higher. So once this fair value gap was inverted, price action moved up, came back down, retested it, and then went higher. That's an inverted fair value gap. So we can see that, like I said, on all time frames. So that is one example. Let's look at another day. This day is Tuesday. Well, we will still use the 5-minute chart. Let's see if we can find a good one. That's not really a good example. Okay, well here's an example of how price did not revisit. We had a bullish fair value gap that was created right there. Okay, however, what happened? Well, price did not move. It did not come back into the fair value gap. It just kept going up and did not retest. Okay, so again, they don't happen 100% of the time, but they do happen, I would say 90% of the time. On this same day, we have candle 1, candle 2, candle 3 on this 5-minute chart. What happens? We take the topping tail of candle 1, match it up with the bottoming tail of candle 3. okay? And this would be a bullish fair value gap. Why I cannot change the color of that? There it is. So what does price action do? It moves up in such a large amount in a quick amount of time. It created the fair value gap, came up to this high. It came down and retested that area. It retests the area, retests the fair value gap, comes into the imbalance, and then price moves higher out of it. And so we start to see price action move higher out of the fair value gap. And then that gives us an educated guess of what the market's going to do then, because sentiment changed. Or in this case, the sentiment stayed the same. It validated our bias of that day. If we move down into a 3-minute chart, 3-minute time frame, we see how it retested this area multiple times, but then we get this big green candle right there that comes up. So if I'm buying this, if I'm going long, then I'm going to put my order somewhere in this area right here. Your stop would go, and we're not going to talk about stops, but normally the stop will go down in here in this area. And then the price moves higher. So that's fair value gaps. That's how they are beneficial to us and how they work. Now, the next, I use fair value gaps a lot. They are a very strong indication, a very strong confluence. So now let's talk about order blocks. And I have notes because my brain I'm old and brain foggy. So an order block, okay? Order block is a price range where orders were able to be filled, okay, and it causes the price or it causes the market to change direction, and it causes a break of structure. How does this benefit us? If large amounts of orders, if they were able to be filled there at that price, and then price revisits that area, then more orders are going to be filled. And then we know that price will likely move in the same direction as those orders are being filled. So, how do we identify what an order block is? And again, this can be done on all time frames, dailies, weeklies, or whatever. So we see here, let's find a good example. Okay, so one example would be here. All right, so we have this weekly low right here on that candle. That candle made a weekly low. Then what happened? Price moves up, it comes down. We're in an uptrend, but price comes down, sweeps that liquidity, and then eventually starts to move higher. So the leg up of the order block is what we're looking at. Is that area right there, that big fat area, okay? What eventually happens? It makes a high right here. Price then moves down. What caused the sweep? The price is going to be the leg up, so it'll be from this area here up to that area there. That creates a bullish order block, because the previous move, it's the previous move that created the downward move, which means that price, okay, there are still resting orders sitting right here, because we don't know if all of those orders were filled or not. If this was a swift, quick move, there may still be resting orders sitting right here. So what happens? It comes down, comes back up into the order block, gives us more confirmation, kind of like a fair value gap, that the orders are going to go down. But then it reverses and moves higher. I'm not sure exactly what the statistical analysis is on how many times order blocks are retested and revisited, but I would assume that it's maybe the same amount percentage of what fair value gaps are. So that's an order block, and they can be found on daily, weekly, again, any type of time frames that we see. So let's find another example here. Okay. So here we have, this may, I don't know. So we have a low right here. Then what happens? We have this sweep, or we could even use this sweep right here. Okay. This made a low, price action came down into it, swept this liquidity, and then came back up. Then what happened? Price moves lower. What was it that caused this sweep? It was this move right here. Those 3 green candles right there. That's the order block. Now, on the third candle, it created liquidity at the top. So we have this sweep down. It moves back up into the order block, moves back down, but eventually what happens? We eventually have a change of structure, a break of structure with this candle right here. That gives us confirmation, confluence, that we are expecting market sentiment to change, because on this daily chart, the entire trend was downward. It was a downward trend. It swept liquidity down here, came up, retested the order block, rejected it at this point, but then came up, came through it, had a little consolidation day right there, a couple of days, and then it broke that liquidity line right there, this liquidity line right here, and then moves higher. Okay? Quick and dirty. So we look at the leg up, look at the leg down, whichever one it is, if it's bearish or if it's bullish. We look at the initial move. So the initial move, once again, or we could even use this example right here, may be a better example. Right here, we had liquidity. What did this do? It came down into this area, and then we see price action move out of that area and moves up. Where is the order block? First of all, let's talk about the liquidity sweep. So at the top of this candle here, we had liquidity. It swept, but then this day it did come back down. However, we have a break of structure because this day, this daily candle here closes outside of the order block. Where is the order block? It's going to be the downward move before the downward move right here, before the sweep, before this sweep, before the sweep of that liquidity. So whenever we make our order block, it's from here down to here. We see price action come up, take that liquidity. This day it rested and then moves higher. Changes the market sentiment and moves higher. That's the quick and dirty of what an order block is. These are two confluences that can be very powerful in your technical analysis of understanding how to trade, understanding where to take a trade. So that's it. So yeah, quick, simple, and dirty, fair value gaps and order blocks. So this is the second installment of Trading Concepts, and I'll do another video in a couple of days and go further. Any questions, comments, whatever, let me know, and I'll talk to you later.